Hi, everybody. This is Vicky Pizzarelli with Engel and Volkers. I'm a broker associate there. This is my YouTube channel, Coffee Talk with Vicky. And again, I have John Belmore here, sales manager of Embrace Home Loans. Welcome, John. We're doing a little segment here for 2023 to help buyers have their path to home ownership. I think this is still a great time to buy, and there's so much to know and learn about buying a home. So we're kind of breaking it down for you guys and trying to have these segments every week for you. So what we're going to talk about today is DTI.
Yep.
We're using foreign terms here, another language. And John, tell us for people that haven't seen you before or don't know who you are, tell us about yourself and tell us what DTI is and how it factors into a mortgage.
Absolutely. Thanks, Vicky. Yeah. So I'm the sales manager at Embrace Home Loans. We have a shop at 620 Main Street in East Greenwich. I'm licensed for many different states all over New England and out west and down south. So if you need any help, let me know. I've been with the company for going on 8 years now, and I run a small team, our branch there. And yeah, like we said before, we're starting with the basics. It was resolution to buy in 23. And then we went into kind of some credit basics, some loan program basics, and now we're on to DTI. Lots of more. DTI is one of them, and that's debt to income ratio. So Vicky, if you don't mind sharing the screen here, we can get that process started as well. So debt to income, essentially that is what kind of monthly debt you're carrying to how much income you're taking in. So what is it? Why does it matter? It matters because there are certain requirements for your ability to repay a loan. So if we didn't have this ratio, you could essentially tell us that you made X amount of dollars and it wouldn't matter. You could make $1 or $10,000 a month and it wouldn't matter. Most mortgage companies and most loan programs have these maximums built in. So the lower the DTI, the better chances you are of getting qualified for the mortgage. Essentially, you're looked at as being less risky to the lender itself. And, the bottom line is it's used to predict your ability to repay the loan that you're asking for. And so that's why there's some of these minimums.
Now, let me ask you, when you have, so say, for instance, somebody like in my field, I'm self-employed and I use my credit card for expenses, for marketing, gas, and everything, just to keep it on one credit card, but I pay it off every month. How does that work with, like, does that get factored in? Okay, we see that she uses it monthly, but she pays it off also.
So here's a two-part question. So with you're 1099 or self-employed, right? So we can look at your tax returns, and we'll get into this a little bit down the road, but we can either look at your tax returns or we can look at cash flow. So looking at the tax returns is the traditional way, the qualified mortgage way of looking at your income. But if you are what I call streamlined with your taxes because you want to write things off, there are a few things I can add back in, but it's not much. So your bottom line, just using a round number, let's say you made $100,000, you write off all these expenses and your net at the end of the year is 30,000, right? So that would be generally the number I have to use to qualify. With somebody who's W-2, if they make $100,000 W-2, that's what they make. So there's no deductions you can take off of that. So with somebody who's self-employed, we go off of that net number. W-2 is gross. So there's a big distinction there. In terms of your credit card, that's your utilization. So it goes into factoring your credit score. Utilization is 30% of your score. But on the flip side of that, we don't look at, you could be carrying $100,000 of credit card debt. And if you pay it off every single month, that's fine. Generally, the credit card companies won't produce a zero unless it's an American Express, because they do theirs, they kind of have open credit. But we would either use 5% of your balance as an estimated monthly payment, or we would take whatever they have as their minimum. So normally credit cards don't go under $25 a month. So if that's how it's presented on the credit report, we would either take 5% of the balance if it has a zero, or we would do that credit minimum, which would be like $25 a month. So that's the big distinction for those credit cards.
Yeah, I know. And I know a lot of people that are 1099s and they have like a lot of debt at a certain point, but then they pay it off. And so it's like you're constantly juggling back and forth. So I know if you're self-employed and you're looking to get a loan, really talk to a loan officer, because you got to learn how to juggle your debt when you're trying to get to that point of buying a home.
Absolutely. There's like a Excel spreadsheet that I made that will essentially take your gross, what they call gross receipts, your gross income. And then I look at certain line items, you know, it's depreciation, depletion of assets, business use of home. I can add those things back into that income. So even if you end up, you know, you start at 100, you end up at 30,000. Let's say you wrote off a good portion. I can make that 30,000, say 45 or 50 or 70, whatever those numbers come out to be. So the big distinction is that W-2 people, it's gross income when you're trying to calculate these debt to income ratios versus net income on somebody who is self-employed.
Right.
So there's two types of DTI. So what we call the front end DTI, which is essentially just your housing expenses over your income. And then there's the back end DTI. So that's housing expenses plus your other debt. And when I say other debt, it's generally just what's on the credit report. So if you have 2 or 3 credit cards and you use them, you know, sparingly or whatever, you pay them off or you carry a small balance, we'll take that monthly minimum. That's the big thing. I don't really care how much debt you're carrying. It's all about how many, you know, how much your monthly payments are. And then we add in, you know, personal loans, student loans, auto loans, collection accounts, as long as they're non-medical. We add these things back in. Any private debt that you have, maybe a private mortgage or some sort of private loan, you have to disclose. And then we would need to see the promissory note with your minimum obligations, and we would add those things in as well. So there's a distinction between the front end and the back end because there are different limitations. You know, they don't want your total DTI, which we call your back end DTI, to go above 57% in most cases. If I'm, you know, imagine you're a W-2 person, you're making $100,000 a year, that's $8,333 a month. If you're utilizing more than 50% of that amount of money, then, you know, we're actually using a lot more. So you can get yourself in trouble because you can qualify for a mortgage with more than what you actually take home. You're not taking home that $8,333 because you're funding your insurance, you're funding your 401k, you're doing all of these things. And the big difference here is we do not count other expenses such as, you know, gasoline, groceries, insurance. We don't count those things when we're figuring out these DTIs. So you really want to be careful because we are almost a little bit too lenient on how we're calculating a W-2 DTI. Now, self-employed, different.
I always say, like, have a payment in mind that you're comfortable with every month paying, and go from there. Like, don't overextend yourself, because it's, you know, you don't pay, you don't stay. You know, for
yeah. It's very easy for these numbers to add up quickly too.
It does. And God forbid something happens, or the furnace breaks, or you need a new roof, that can just that can really destroy you if you're not factoring in other things besides just your mortgage. So just be comfortable with your payment every month. That's the key. I find for myself in particular too. You know that number you're comfortable with, and try to stay looking at homes that you know that's going to be your mortgage payment.
Yeah, I always say that. You know yourself better than I ever will. You know what your expenses are, and I always tell them there are things that I don't take into consideration. So if I'm telling you you can afford X amount of dollars because you're at 50%, that's not recommended to get to that level, because there are many other things that go into, owning a house. Let's say the water heater breaks, the car breaks down, you have, you go out on a medical leave for some reason, right? You don't want to be just stretched so thin that you can't have any wiggle room.
Yeah, exactly.
But this is a quick example of how DTI is calculated. We take assuming that you're renting and you're going to be purchasing a house, so the rental goes away, we would factor in your new mortgage amount, right? So let's say it's $1,000 in this example. You have a $400 car payment and then $600 a month in other bills. Other bills, again, meaning just stuff that's reporting to credit. And these are monthly minimum recurring payments, not your, anything that's, let's say you're paying $200 a month on your credit card, but they only require 25. We're going to go off of that 25. So you take that and you divide that by the income, so debt to income, and then you get that particular number. So this is how to calculate the back end DTI, your overall picture. So the Back end is, 50 to 57%, depending on which program you're using. They want your front end, which is just your housing expenses over your income, to be 43% or less. And
yeah,
again,
so you got to factor in, the consumer has to factor in daycare, gas, like, all those little things that pop up, So like we said, you can get into a lot of trouble if you don't figure that stuff in. I've seen back in years way back when people were losing their homes, and it was a big crisis, and people were overextending themselves way too much.
Yeah.
And I think, well, the lending laws have gotten a lot stricter since then, which is a good thing, because it's keeping a lot of people out of trouble right now.
Yes. Yeah, because I was just going to say, it's actually kind of hard to get a mortgage right now. I've got a lot of people I just can't help because of, number one, the rates, increased so drastically that it priced a lot of people out of the market. The values haven't come down enough to kind of stabilize or equalize those. But just at, they don't want to spend that amount of money. You know how much you're comfortable spending. You know how much your rent is. Even if you can afford the house, doesn't mean you want to, or you're prepared to do so. So you want to think long and hard about this. This is a basic, step. Calculate your own DTI. How much money are you making? How much debt do you have? Can you add a mortgage into that? So
yeah, I mean, you got to be very careful. I mean, and everybody wants the big, beautiful, brand new house and all that. But like, if you're just starting out, start out small. That's not your forever home. Yeah. Most people will move within 5 years, or maybe 5 to 10 years. You outgrow it, or you don't need that size anymore. So if you're a first-time home buyer and you're just starting out, you don't need the big bells and whistles and everything. Work from one spot and use that home to build your wealth and to get a bigger home if you want, or investment property. And I always tell younger home buyers, like, don't start out with that big giant home, new construction, everything's brand new, and then you start having kids, somebody wants to stay home with the kids, or the childcare is too much, and then just stay within your means, really, because I've seen a lot of people get into trouble that way over the years. I've been doing this a long time, over 30 years, and I've seen a lot, and that's one thing I always try to advise my first-time home buyers is start small and build your wealth.
Yeah. I mean, you said it before. You want to just have a payment that you're comfortable with. If it fits within the box of, what's considered a good debt to income ratio, then perfect, So these are some ratios of all the different loan programs. So conventional, like I said, they'll allow you to go to 50% of your income for your back end, which is like everything included. Front end, they generally want 43% or less. The FHA, I've seen 57%. The VA has no upper limit. I've seen these things run into the 60s. As long as you have a good credit profile, we run all of these things through some desktop originator and underwriter software before it even gets to the underwriters, the actual people. So we'll let you know up front whether these numbers are too high. But if you're hitting these maximums, I really hope that there's some sort of a safety net that you have in order to help pay in case, you run into some trouble.
I mean, I always say, you guys you got to put a big, nice story together for the underwriter,
Yeah. Yeah.
I on my end of it, I'll hear buyers complain that, oh, they're asking me for this, they're asking me for that. Well, if you're borrowing hundreds of thousands of dollars, the bank wants to know you're going to pay it back. And if you were loaning that kind of money, you'd want to know that person you were loaning it to can pay it back. So it's don't be offended, be happy that they're doing it, because it's for your own benefit. They're making sure you can afford the house. And John's job and his processor's job is to make sure that story and package is put together really well, so that underwriter doesn't have to come back and ask any questions.
Right. I'll be your best friend, but I'm going to tell you things that you don't want to hear. Yeah. I'm going to be truthful and transparent, because, it's all going to come out in the wash at the end. If I'm not honest,
lie. You're going to find out.
Numbers are numbers.
Tell the truth, nothing but the truth. So help you God, because he'll find out.
Yeah, exactly. Well, so let's say you're struggling with your DTI. You did your numbers yourself and it's a little too high. So whenever I look at our credit report, it gets pulled into a debt sheet. I can sort your debts by your payment to balance ratio. So if you have a really high monthly payment with a very little monthly amount remaining, that creates a scenario where I can say, look at this, you're spending $250 a month on, $1,200 debt. Get rid of that thing, right? And then that eliminates $250 from your expense sheet without using a whole lot of money. So pay off very small debts and ones that are small balances but high monthly payments, and that'll decrease your DTI and increase your chances quickly. A lot of people say raise your income, which sounds easy, but if you have side hustles, so let's say you're W-2 and then you're driving for Uber, or you're doing something like Fiverr or something like that, where you're doing 1099 work on the side. If it's cash, I can't use it. If it's 1099, you have to be doing this for 2 years. If you have, a part-time job after work, even if it's W-2, you need a 2-year history of these things to work these jobs, side by side. So side hustles are a great idea to bring money into your household, but it doesn't usually, at least in the short term, help you qualify. It's not a quick fix to that.
How do you factor in overtime? If somebody has overtime, how would you factor that in?
Yeah, same thing. You need a 2-year history of these things. So if you're, it's all averages, right? Because nobody can predict the future. So we go off of a 2-year average and then what is happening year to date. And then we generally get what's called a VOE, a verification of employment and income. And so we'll ask your employer, on the form, it's what's the likelihood of the job continuing, And so with those 3 things, as long as you're on track to make the same or more, then your history is good. But yeah, 2-year history.
I'll tell you a funny story though with the VOE. I had a client, lender called. He didn't know he was getting let go, and
that's awful.
And his employer told him we were actually going to be laying him off this week, and I was like, oh my gosh. So,
that sucks.
Sometimes you find out things, but like I said, I've been doing this a long time. I've seen a lot of things. So yeah, that was a tough one.
I've had a few where they, retire early or something like that, So we used to have people fill out an affidavit that they were going to continue to work and all this other stuff during COVID, because it was just such an unknown territory for everybody. And so the guy had said, yeah, I'm going to continue work or whatever. And we ended up doing a final check. It's called a 10-day T-cert, which is a telephone certification of, are you still employed? Usually we do it within 10 days. And the employer said, oh, he just put in his resignation. He's got 2 weeks left and he's retiring. We're like, oh, okay, well, we can't. So he had to go. I mean, he's had to go back and, renege on that, which, the underwriters didn't like, because, obviously he's going to quit once the loan happens anyway. So we ended up having to cancel that whole deal. So yeah, just be careful with that stuff. Yeah, no,
like I said, speak to your real estate and mortgage professionals before you do anything like that.
Yeah. Lay low credit wise, lay low job wise, just lay low in general. Ask as many questions to, Vicky and I as you can, because there's no dumb question. There's not too many questions. We've generally between us seen it all. So we'll have
I'd rather you ask than not to ask, really.
Yeah, exactly. One big thing with something is cosigners. So we mentioned before, don't never say never. Generally avoid cosigning, but if you need to, we can do what's called a non-occupant co-borrower or cosigner. So, let's say you're somebody early on, just out of college or whatever, and you're trying to qualify, but you can't. If you have somebody who has stable income, good credit, you can have them apply with you, even if they're not going to be living in the home. So some programs will allow for that. So that's a really quick and easy way to utilize their income to reduce your DTI without making any changes on your side, right? So you're not changing your credit report or, anything like that. But the flip side of that is whoever you're asking to co-sign, they're going to be on the mortgage. So they're going to have to absorb that debt and be able to do so as well.
Yeah, and make sure you pay it, because you're hurting the person that's trying to help you.
Absolutely. Yeah, make sure you pay. But I mean, that's the basics, I would say, about debt to income ratio. Not all debt is treated the same. So, collection accounts, if you have a collection on there, there's no minimum monthly payment. So we'll use 5% of the balance. If there is medical collections, unless there is, you know, a lot of medical collections, we can generally ignore it. Student loans is a big thing right now because the government still is not accepting loan payments. So, you know, the FHA and Freddie Mac will allow us to use 0.5% of your balance as a payment. So like almost every one of them is in forbearance right now. So when it comes back on the credit report, it says, you know, $20,000 owed and then 0 for the payment. Unless you can get us a letter, we can do income-based repayment plans and that sort of thing, depending on the loan program you're using. So general rule of thumb is 0.5%, and Fannie Mae is at 1% of their loan balances.
Yeah, and I know a lot of buyers, especially with student loans, a lot of them are afraid to even look at a house. They don't think they qualify because they have a student loan, and that's not necessarily true. Again, speak to someone like John. He's going to guide you in the right direction. Don't assume. I keep saying this. Don't assume. I hear so many times I'll get people talking to me and like, oh, I can't get a mortgage. I have student debt, or my credit score is not good enough. And they just don't, you just don't understand. And we don't expect you to understand because you don't do this day in, day out. But instead of assuming, ask, because, you know, rent is always, it's always there. You know, you don't own the house. At least if you have a home, you have a tax write-off. You can paint the walls whatever color you want. You have an investment, and you can build your wealth from there. Yeah,
and there are things too. You know, house hacking, I guess, is a popular term these days. You know, you can go and buy a 3 or a 4 unit place, even if it costs them like $1 million. Like, let's say you're trying to buy a Newport. The prices are astronomical right now for multi-unit homes. Everything's north of $1 million. If you can, yeah. So let's say if you can even find one, right? You can utilize the 2nd, 3rd, or 4th units to help you pay your own mortgage, which decreases your DTI, right? And so it kind of eliminates some of the risk on your end. You know, there are things that you can do. DTI is manipulated quickly, I guess is what I'm trying to say. It's not like credit where it's going to take 30, 60, 90 or a year in order to make changes or arrangements. You know, you don't have enough income, get a second job, you're waiting 2 years to use that income, right? So DTI can be manipulated quickly by paying off debts, adding cosigners. It's just a net number that we utilize in order to gauge. It's one of the, you know, 23 factors. So it's much more easily manipulated than some of the larger items that will stay with you for a long time, because these are snapshots in time. What's happening right now? No one's guaranteeing that you're going to be in the same job or have the same amount of income. So we just have to go off of what's today.
Yeah, and you know what? And when you own a home, I don't know, miraculously the universe brings other opportunities to you and brings you more money that you need to do things. And and like I always say, the younger buyers, you know, don't start out with a multifamily. Like John said, buy multifamily. If you're single, you're living by yourself, live on the top floor where they get less rent, and rent out the other floors where you're making more money, and build your wealth on that. I know some home buyers that bought their multifamilies, kept it as rental income, which they were able to use for their mortgage, and then buy their single family home or another multifamily home. So it's a stepping stone.
That's exactly what I did. You know, we bought a 2-bed, 1-bath ranch when we first started, and you know, we utilized, it was, you know, like it was something that was more affordable for us at the time because, you know, we were just starting out, and you know, we slowly built up a bit of equity in order to move forward. You know, I'm sorry for the dog.
You know, when my dog's gonna start barking, I'll watch. Yeah. That's okay.
Yeah, I mean, but that's the end of it. You know, if you have questions about how to, you know, you want a calculator for the DTI, I can email you an Excel spreadsheet for you to fill in some certain numbers. If you have questions about specific scenarios, because everyone's unique, right? Everyone has different qualifications, specifics about their employment, their income, assets that they have right now. So yeah,
absolutely. Don't assume. Everybody's story is different. So speak to John, speak to myself. John's information's up on the screen. We'll have it in the chat. And don't assume and reach out to us. We'd love to help you get towards a home ownership. You know, that's our goal, is to help as many buyers as we can get towards home ownership. Also, if you're a seller, just because you qualified for a mortgage when you bought your house doesn't mean you're going to qualify for another one.
Good point.
Reach out to John, check your debt to ratio, check your credit. Again, don't assume. I get that a lot too. You know, I own a house. I shouldn't have a problem buying another one.
Yeah.
Well, you'd be surprised. So,
well, let's say you bought a house 2 years ago when interest rate was 3%, and you know, income hasn't increased as fast as inflation, right? So maybe you carried a bit more debt. You had to replace a few things. You've got a home equity line of credit against the house or something like that now. You know, you may not be able to qualify for the same, especially with the way the rates are right now.
Yeah. Yeah. So, you know, and I get that more often than you think. It's, you know, a lot. I always, before I even list the property, I say, talk to a loan officer, see if you can even move, if you can do what you want to do before we start putting your house on the market.
Right.
It's really important. Yeah. Again, John, great segment. Love seeing you. Thank you again. And we'll see you next Wednesday with the next segment towards home ownership.
Perfect. Thanks, Vicky. Appreciate it.
Thank you. Have a great day.
You too.